panelists on stage to join me, please. Thanks. Thank you very much, Minister. That was very insightful. Having grown up on a farm in Zululand in South Africa, I wear Africa on my sleeve, and I have the dirt of Africa under my fingernails. And I think many of us are working towards supporting, our governments with the challenges and taking advantage of the opportunities that are out there for Africa. So thank you for that insightful speech. Okay. Hi.
Hi. Nice to see you. Good to see you.
Okay. All right. Bear with me. I have lost my place. Perhaps I can start by introducing my panel. That's the easy part. From left to right, Charlie Robertson, Michael Mensah, Shailendrasingh Sreekeessoon, and Akshay Grover. Apologies. From Seeruttun, from SBM, from the Development Bank of Ghana, and FIM Partners. So we have a collective mix of macroeconomic strategy, development banker, commercial investment banker, and disruptor fintech solution provider. So perhaps just as a backdrop and stealing one element of the conversation, your speech, Africa has an amazing opportunity out there. We're talking about banking. Banks are integral to providing the support that an economy needs to drive itself forwards. In its most simplest form, a bank is there to help people save and then to find innovative solutions to deploy that capital. Banking 101. But macroeconomics, geopolitics, they affect the way we are able to deploy that capital. Charlie, perhaps you could just start us off with a little bit of a update and some insights on macroeconomics, how it's affecting Africa in different ways, and you've got a unique analytical insight that you're going to share with us as well that I found quite interesting.
Yeah, it took 25 years for me to work out why we have a savings shortage in Africa, and that savings shortage, the African Development Bank says we need, $170 billion for infrastructure. I think that's out by about $5.5 trillion. I think the infrastructure gap's about $6 trillion a year. China invests 40% of GDP, same population as Africa. That is about $6 trillion or so a year is what China's investing in its economy. We haven't got an infrastructure gap of $170 billion in Africa. It's vastly, vastly higher. And there is no way that foreign capital can fill that gap. The only way you can fill the gap is through domestic savings. And you cannot have high domestic savings in a country when family size is as big as it is, when the continent is too young. So the history of humanity is we all go through a very high fertility stage of 5, 6, 7 kids. In my great-grandparents' case, it was 7 or 8 kids, and they had no money, and they collected water from a well. They had no electricity. They lived in poverty. That is the norm of high fertility countries. High fertility countries have bank deposits to GDP of 20%. 20% in Nigeria, 20% in Ghana, 20% in Tanzania. It doesn't matter which high fertility country you go to, they don't have high savings at a household level, so they've got no savings in the banks. And if there's no savings in the banks, only 20% of GDP, the cost of capital is extremely high. And this isn't because the world is mispricing the cost of capital in Africa. If you go to Mauritius, which got its fertility rate below 3 kids per woman in about 1980, bank deposits are massive. And the reason Mauritius has amazing infrastructure is because high bank deposits equals low interest rates equals fantastic infrastructure. What Mauritius pioneered in the 1980s, Morocco started to do in the 2000s. How many of you have been to Morocco? And were you impressed by the roads? Were you impressed by the railways? Were you impressed by the airports? It's amazing what you can build when your interest rates are 3%. And your interest rates are 3% because your bank deposits are nearly 100% of GDP. Plenty of capital. So we have a problem in a lot of the continent because the fertility rate is too high. Therefore, there are no savings. Therefore, bank deposits are low, interest rates are high, so what do governments do? Do they accept that status quo and say, we just don't have the capital to invest, or do they borrow from abroad? In the last 15 years, they've borrowed domestically, they've borrowed from China, which has lent $1 trillion of its excess capital to the Belt and Road Initiative, and they borrowed from global markets. And they borrowed, and now, unfortunately, all that borrowing stopped. Debt levels are too high again, China's not lending anymore, global interest rates have shot up. So we now have debt problems in Ghana, Zambia, Ethiopia, and debt potential default problems in Kenya, Nigeria, and indeed Egypt, as well as many others. And that is a natural consequence of the fact that there aren't enough savings. What we do have is the best educated population on the continent we've ever had. That's wonderful, because good education eventually, after a generation or two, leads to lower fertility, leads to smaller family size and savings boom. That's what Asia did in the 20th century. Africa hasn't done it yet, outside of Mauritius, Morocco, Seychelles, which are some of the richer countries on the continent. So what we have now is excess labour supply, shortage of savings. What does that mean? It means emigration. Just like the Philippines did 20 years ago, like the Irish did 70 years ago, like the Europeans did in the 19th century when the Europeans had too high a fertility rate and not enough savings. They went to America, Australia, South Africa, Argentina, Canada. And that, unfortunately, is going to be the story for the next 10 to 20 years. So the banking system is going to stay with a shortage of funding for some, particularly countries like Nigeria, Congo, Angola, with very high fertility. But it's already changing right now in places like Egypt, which by 2030 will have even more domestic savings, Kenya, 2030 to 2035, Rwanda, 35 to 2040. Savings will grow, interest rates will come down, these countries will boom. They will boom for generations. In the meantime, we get a very high return on capital investing in the banks, because the banks have the advantage of not very many savings and everyone's prepared to pay a lot for those savings. So the return on capital is amazing for the right banks in the right part of the cycle. And I think that's very interesting. And then it's up to innovation to try and maximize what the banks can do with the limited savings that they have. And I'm hoping we answer some questions on that in this panel.
Yeah. Thanks, Charlie. Michael, development banks are at the cornerstone of building the foundation that a country, a region needs to support a flourishing economy. Ghana is having challenges at the moment, and I think that building resilience into the banking system could help to generate that the green shoots that Ghana requires. How is the Development Bank of Ghana addressing these challenges and working with the banking community to help to find solutions?
Thanks, Charles, and thanks, Charlie, for that introduction in terms of how the high fertility is driving lack of savings. So, whilst we're waiting for that problem to be solved, at least we can look at what the conventional approach is, which is how do development banks support economies that are struggling when it comes to some of the key things like high inflation, high interest rates. So the Development Ghana was purely set up to address some of these challenges, where you see high interest rates in terms of the return on capital from the commercial banks. But our key role is to be able to intervene between what the commercial banks are trying to do and how the government can support the growth of the economy. And we do that by providing the type of capital that is not available to local businesses to support growth. So we are able to provide or intervene in the market with long-term capital at competitive rates to the productive sectors of the economy. Where you see that a lot of commercial banks focus on the short end of the yield curve in terms of short-term investment, and that does not actually support long-term sustainable growth. And therefore you see in Ghana, for example, very little funding going into the key sectors such as manufacturing, agribusiness, ICT, where we know that in every developing economy, these are where you can actually create sustainable jobs, create sustainable growth and actually support the economy and reduce the impact of having the government go out to sort for long-term expensive capital. Again, some of the challenges being faced in countries like Ghana is being so dependent on inflow. Capital inflows means that, and imports means that you're not generating enough revenue to be able to support government budget. And then you're supporting government budget by borrowing on the capital market at high rates, using to fund that. And that eventually leads to some of the debt sustainable issues that we have. So the DBG or the Development Bank Ghana is actually being able to close that gap, come in with the type of capital that is required, invest in the productive sectors of the economy, support the local businesses to grow with the view that long-term dependency on international markets and imports will be reduced.
Thanks, Michael. That's very interesting. So the development banks are building that base, that foundation that the regions need in order to create and develop GDP growth. Shailen, on top of that environment that policy and development banks and other investors create, how is SBM and how are you seeing the banking sector take advantage of these tools that have been given to the commercial banks and the environment that the commercial banks have to navigate in order to achieve success for their various stakeholders, for borrowers and for those that are borrowing from you?
Yeah, thanks Charles. Look, I think banks have been the lifeblood of the economy for many years. As you know, banks intermediate between providers of capital and people who need capital to realize their dreams or build their businesses, right? Very often banks have been compared to, they have been the ones who have been giving umbrellas to people when the weather is good and then taking them back when the weather is bad, right? That's what bankers are known for. But I think that has changed. If you look at, for example, when we had the COVID pandemic, banks did the extra mile to support businesses, to support the people, and ensure that the economy gets running, the clients are, like the businesses keep running. For example, at SBM, we had introduced a scheme to give unsecured lending to people who were stranded overseas when there was COVID. And they couldn't travel for many days, and they didn't have money to pay their hotel bills, their return tickets, etc. So we are really there with the clients, with the businesses. What we have seen as well is the growth of partnerships, right? 15, 20 years back, banks were kind of trying to do everything themselves, from the technology to the products. Now, increasingly, we work in partnerships. Not everyone knows everything, or not everyone excels at everything, right? So from fintech providers to and the support of regulators and governments, I think it's a partnership, and that works. So, for instance, if I go back to the COVID example again, the Bank of Mauritius introduced a moratorium for clients. So this helped the clients navigate through the tough times until the times that the businesses grew up again and were able to service their debts. So, but we have seen that banks have come under increasing challenge as well over the past few years. In many African countries, returns on equities have gone down. I mean, even in Mauritius, prior to COVID, returns on equities were under pressure. And there are typically three ways that we look at that. One is how we grow the revenue, how we manage the cost, and how we manage the cost of risk, right? In terms of growing the revenues, the challenge has mainly come from fintech, whether from new providers or for existing competitors, because fintechs come at a lower cost, right? When you use your mobile, you don't use your cards and you get lower commission. So it's for us to build onto that network to make customer service better. So clients now need access to services instantly. So a lot of investment is going into technology for that purpose. To reduce costs, because even to be able to do that, the processes have to be automated. Now, African banks have been leading in terms of some of the mobile products that have been launched on the market. But in terms of using analytics and AI and all these other technologies that can really reduce costs and improve the service, I think there is effort that needs to be done. And even in terms of the cost of risk, I think the compliance costs, etc., have become very expensive now. And to use technology like AI to be able to do that more effectively and real time, I think is a good opportunity in the banking market. Now, in terms of new products, what we have seen trending is, apart from the technology, is the ESG, as the Minister and as Raul has mentioned earlier as well. So, for example, the framework for green bonds has been revamped in Mauritius, and we are seeing that so the taxes on interest on green bonds, you don't pay taxes anymore, so that makes it very interesting, and we have seen an increase in interest for green bonds on the market. So I think it's, as the other panel members were saying, it's to constantly innovate, to understand the client needs. Now, last week, I was having a discussion with a client who wanted to launch a new business, and after the discussion, he was very happy. He said, "You know, I don't need money; I need advice." Right? And I think this is the direction that we need to go to do more value added for the clients.
Thanks, Shailen. So I think that finding those innovators and finding those disruptors to partner with is critical to solving some of the issues. So, Akshay, last but not least, you are perhaps the disruptor, the innovator, those that are looking to solve the problems and look for strategic solutions that you can deploy with partners in the sector. How are you finding those opportunities, and how are you? What's the experience in deploying them, teaching you?
Yeah, I think just starting off before I address that quick question, and I wanted to respond to Charlie's point about the macroeconomics. I think that's very important, but I think the today problem, and that's not a problem that's going to get solved for like 10, 15 years. So I'm thinking to myself, what solves that problem today in Africa? And I think the serious problem today is capital allocation and the decision for capital allocation. And if you think about it, banks, financial institutions, what percentage of their capital is invested into government bonds? And I think somebody talked about that earlier, right? I mean, that number, so the government is basically crowding out private sector. That's one problem, right? You got to figure out what's the answer to that problem today. And I think only the governments and central banks can really address that issue by saying, this is a mandatory capital allocation that you got to do to X sector, Y sector, Z sector, which will enable actual development capital to come into sectors which are needed, right? The second problem I find is, of the very little capital that's left after what's already been deployed back to the government, right? You have another challenge, which is lack of sufficient innovation on what the industry needs, what customers need, and how that capital should get allocated. Yeah. Today, if you look at banks and financial institutions in Africa, the reality of it, and I'm speaking more broadly, so no particular country, but I'm speaking more broadly, but if you look at it, the question I would say is, what you find that capital keeps getting allocated to either industries or businesses that meet a certain criteria, and nothing else gets capital. And so you find that small and medium businesses that can actually contribute to GDP growth and to economic expansion, don't get the capital that they should get. And I think this is exactly where fintech comes in, or one of the places where fintech comes in, is because you have a problem that you don't have KYC information, you don't have tax returns, or if you have tax returns, they are not disclosed appropriately. You don't have data which says defaulted with one bank. Is it available? Is there a master database of defaulters, etc., etc. And so through that myriad of problems, which have not really been, from a digital point of view, addressed by either the government or the banks and financial institutions or regulators, fintechs are coming and saying, I will take this data based on A information, B information, C information, which today traditional banks and financial institutions are not accessing. I will analyze this data, I will find a way of making sense of it, and then I will enable a better capital allocation to these businesses / individuals that actually need the capital, and that can potentially impact growth. Yeah. So I think that's where I see fintech coming in. And the second area I see fintech playing in is actually just making the economics of a transaction a lot more sensible. I mean, it is horrendous to say this, but the cost of a inflow into Africa is almost 8%, was 8% 3 years ago, 4 years ago of the transaction value. So on a $100 transaction inflow into Africa, the sender would and the receiver would be losing $8 on transactional costs. Today that cost is already down to 3-4% thanks to fintechs. Maybe it will be down to $2 in the next 12 months is where I see that number going down. And if you think about it, you do a wire transfer from sorry, I don't like it because there are a lot of Mauritians here. You do a wire transfer from Mauritius into a bank account, it costs $50 to do a SWIFT transaction. I mean, that makes no sense, right? So I think some of those structural barriers on capital flow itself is something that fintechs like Cellulant and many others in the industry are trying to address.
Cool, thanks Mark. Akshay. Michael, back to you. Development banks have quite a tricky game to play with their commercial banking partners and with fintech. How are you addressing the challenges to navigate the current macroeconomic situation, deliver the resilience that we were talking about in the sector, but also help to support these innovative solutions?
Very good question, Charles. I think I have the benefit of having worked also in commercial banking and partnering with, actually done some work with Cellulant in the past. So I have a very good appreciation of the roles that each of these key strategic partners play. What I've come to realize is that each of these stakeholders are critical to any development of any country. However, the key sort of difference I see between their responsibility and our responsibility is that they are always commercially led, which is that the returns must make sense for a commercial bank, for them to invest in certain key areas of the economy that generate the most growth. If I'm to take Ghana, for example, we see the productive sectors of the economy being manufacturing, agribusiness, ICT, and some high-value services such as tourism. But the commercial banks do not necessarily invest in there because of the perceived risk of these sectors. Secondly, the local businesses that contribute the most to GDP are also seen to be, or the lower end of the local business are also seen to be high risk from a commercial bank's perspective. The third thing is what also is the crowding out of private investors by the government, which is that they come in to also have bonds that are generating high interest, and therefore typically commercial banks will be looking to invest in those high-yielding instruments as opposed to investing in those sectors and those local businesses that generate the GDP. So then here comes the development bank, whose key role is not commercially led in terms of profitability, but more of being sustainable and having the developmental impact that is required in the economy. Are we creating sustainable jobs? Are we able to ensure that we are producing enough locally to reduce imports, because the imports have a net-off effect on currency? Are we generating enough or producing locally to be able to export to generate foreign currency? So those are the key KPIs that we have. However, we also partner with the fintech and we partner with the commercial bank. And why is that the case? Because once you are able to create that environment where the perceived risk has been addressed through providing the necessary technical assistance, then you see you're able to then crowd in the commercial banks, crowd in the fintechs to begin to start investing in those areas, and then through that catalytic effect of bringing them on board as well, the impact you will make will be a lot more substantial. But development banks such as DBG will take the lead in creating that environment that allows the other partners to then come in and also invest.
Thanks, Michael. So what you're saying is that it takes more than one party. The development banks can't do it on their own. They need to crowd in commercial banks, fintech, to develop the solutions, to attract the FDI that everyone can then put alongside the savings pools from within the country and develop the solutions to generate economic growth. Charlie, sounds easy, hey? As the macroeconomic fundi in the room. How does that? How do you see that working out? How do we attract the FDI despite the macroeconomic uncertainty and show the economic growth that everyone wants?
Very difficult. You can't really attract. FDI goes to rich countries with great infrastructure. That's what it does. It doesn't go to countries where the infrastructure is poor and where it's hard. So FDI is not usually. It's an ideal. It's a wonderful thing to get, but it's not usually the solution. FDI comes when you've already got good infrastructure, when electricity is great. Morocco's doing it. Massive car sales, car exports. It is a huge success story. Mauritius did it with textiles in the 80s. So you've got to get electricity and some infrastructure. I think where we're at today is potentially at the cusp of a huge change. So all of the data I've collected, which is all the data that exists, says countries where there's one adult to one kid grow at 1.4% per capita. That is sub-Saharan growth. That was Asian growth until about 1990. One adult, one kid, you don't grow fast. Two adults to one kid, you grow at 3 to 5% per capita. Now that's stunning. That is what Asia's done for the last 30 years, which is why everyone loves Asia. So, and it's still doing it. Even Europe is still at 1.8 adults per kid. So they're still doing okay too. So all of that data, though, is based on all of the history of how countries have developed in the past. And they've always done the same thing: agriculture into industry, into services. And we have the opportunity, thanks to the internet, to jump through that and do straight to services. There is the opportunity, the possibility of back office processing, of me buying music from Afrobeats Nigeria online, of me buying apps from Kenya, all the stuff you've heard about, where suddenly your export earnings per Nigerian are not less than $1 a day because of oil. Oil is never going to make Nigeria rich. It's potentially $10 a day because I'm buying some app or some service of a Nigerian who's well educated, sitting in Lagos, and he's got electricity and the internet. The electricity and the internet are vastly cheaper if we focus purely on those than trying to do manufacturing. Manufacturing is, I need roads, I need ports, as well as electricity on a massive scale to fund manufacturing. So what I'm hoping is that all the conclusions of this book, which says we're not going to see takeoff in some countries for 30 or 40 years, but it will start in Kenya and Egypt in 5 to 10. I'm hoping that's wrong, because services and well-allocated capital, cutting the costs that Cellulant is doing, bringing in some low-cost capital from SBM, and what you can do at the Development Bank, those together, if focused on export-generating services, more than anything else. Don't roll out electricity to poor people. We cannot afford it. As a continent, it's unaffordable. It becomes loss-making and value-destructive. focus on export-generating services industry, and maybe that can start to raise the revenues for us to then give what we want to give to everybody in the continent. Cheap power, good housing, good healthcare, and all the rest. But we've got to focus on the dollar earning exports.
Thanks, Charlie. So, based on that macroeconomic outlook and the cold hard facts, we need all three members of the banking ecosystem to work together to develop, to become value-add partners, to almost go through a renaissance moment and leverage off the potential. Shailen, you've got some new products that you've been launching. Akshay, you're heavily involved in innovation. You mentioned briefly how you're working together and how it almost seems like you should be competitors, but you're not. You leverage off each other's strengths to develop resilience and innovation. Akshay, do you want to have a quick comment on that, and then I can move on to Shailen?
I mean, even for us today, as we stand, we partner with probably all the large banks and financial institutions in Africa. And I think for a very long period of time, I felt like the banks saw fintech eating their market share, which might be partially true in some segments. But in reality, the value of banks and fintechs partnering is tremendous. Yeah. And the reason it's tremendous is because the strength that the banks have is actually capital availability, number one, access to deposits, all of that stuff. And the strengths that fintechs have is innovation, is the ability to launch new products much faster, is the ability to say, let's be a little more nimble from a technology perspective to roll out this stuff faster to the consumers. And if you marry the two things, it can be a very powerful combination for the end consumer, for the businesses that need capital, et cetera, et cetera. So I would just reiterate that that's really the direction I see things going.
I think we are out of time, but maybe a quick comment from Shailen and Michael.
Charles, I wanted really to give an example of what has worked in Mauritius. Maybe I'll take a couple of minutes or two. The electricity infrastructure, right? So what the government has put in place is the framework for private investors to chip in, like independent power producers. And they give like 20-year power purchase agreements. So based on that comfort, commercial banks are able to invest. Investment banks are able to structure, and commercial banks are able to invest and are able to attract capital. And eventually, these you can list the bonds, go on the capital markets, and create more capital for the businesses. So for me, it's this coalition between the different partners which is important and which can help drive growth forward and infrastructure development. This is a model that can be replicated and which we have experience and we can help different countries implement.
Thanks, Shailen. I think we're out of time.
Yeah.
Okay, all right. Ladies and gentlemen, I hope you found that entertaining and interesting. A round of applause for my panelists, please.